We're going to walk through a few exciting things today. You guessed it, mostly about market conditions and how what's happening with sales and prices and seller activity and buyer activity and all the fun things that we love to track with you guys. Hopefully you love to track all these things too, but no guarantees. You know, people are afraid of numbers, right? I know you're thinking, sometimes you are. And I think that you shouldn't be. I think that the power of data and of being able to leverage it to help you explain complex trends to your clients, to your customers, it's worth spending a few hours a month just kind of diving into the reports, looking at our local market updates, and just getting a sense for what's happening. InfoSparks is also a tremendous place to do that. And time permitting today, we're off to a few minutes late here, a few minutes past our start time, but I do want to hop into InfoSparks if time permits at the end. And because I want to get through so much and get to InfoSparks, I'm going to stop yapping and rambling and get right into the numbers. Can't remember if we did this last time. I did this in another presentation, and maybe for another week, I'm still flabbergasted by this. 1978 is just as far away from the year 2000 as 2022 is. I still find that interesting. So this one, I don't think you guys have seen. I got a kick out of this one. So on Friday, January 21st, I open my weather app and I read not as cold. And I keep reading and it says 30 below. And when 30 below is not as cold, you know you're living in the right state. Not that long after, 5 days, Wednesday the 26th, another not as cold. Here, wind chill's only 36 below, right? Quite warm. How about our friends over in Florida? A high temperature of 53 degrees. Oh boy, you better dress in layers and limit your time outdoors. What's our friends in Wisconsin saying? Hold my beer with minus 55. Yeah, that's 100-degree difference. I'm sure you're all good people, but I don't have a ton of sympathy. No, just kidding. It's a little reminder that everything is relative, and that applies to the market analytics world as well as to weather. All right, so let's look at some short-term trends, what we kind of call our shorter-term trends. So this shows 2022 in dark blue, and then we've got 21, 20, and we even go all the way back to 19. We've been talking about this for years. You guys can see the COVID impact with 2020 and then 2021, right? We showed a lot of strength above that. 2020 sort of shifting in the back half of the year. This activity was displaced to later in the year. 2022 off to a pretty strong start, right? Looks like we're mimicking 2020 pretty closely. Hopefully we don't mimic this part. I really don't believe we will. And so, it's something that we're watching. Nothing alarming with showings. We're not seeing a surge. We're not seeing, anything declining substantially. So yeah, things are chugging along with showings. So thinking about the overall share of showing activity, right? For every 100 showings, about 15 of those showings took place on listings at or below 200K, right? That's down from 18%, so not the kind of declines that we were seeing, but still a decline. And we even see declines up to 400K. That may be a little bit surprising. We start to see our gains in showing activity as we cross that 400K threshold. Don't discount million plus, literally. You cannot put a discount on million plus. Actually, it's one of the few segments where you might actually get some discounts. So 1.29 up to 2.29. Pretty substantial increase, right? Pretty substantial increase in million plus activity. We see that trickle, or I should say ripple through the rest of our stats and data. Okay, change in showing activity. So this one, again, we're looking by price. And you guys will notice, right, all of our decline, well, virtually all of our declines, the most consistent and I guess dramatic declines are on our most affordable product, right? Under 300, actually even under 400 nowadays. It's a little bit of a surprise again. We see a nice increase 4 to 5, a little bit of weakness 5 to 6, some strength 6 to 8. guys, we're just kind of flip-flopping. I mean, some of this with weekly data like that, it's not a ton of time to have, the most reliable trends. I think it's enough time, not as good as a monthly trend. And, we were joking about it, but weather can impact this, believe it or not. And yeah, so a couple factors to just keep in mind there. We do see million plus flying sky high, right? There's our 52% increase in showing activity just in a year, right? So that's like going from 100 showings to 150. Well, in this segment, it's probably like going from what, maybe 30 to 45 or 20 to 30, something like that. Anywho, so another way to think about the market and of what's happened over the last couple of years is to look at where things fall seasonally, right? Some people say seasonably adjusted, right? Didn't we just look at minus 36? Nobody here is seasonably adjusted. Seasonally adjusted, right? Seasonally, just like how it's a median price, not a medium price, right? But a median price. So new listings, right? This is useful, guys, just to kind of look at the way years are bending or skewing and how that might throw off some of our year over year comparisons. So what are we looking at here? New listings. This is using sort of this, we're using this polynomial based on the rolling weekly numbers. And the first thing I see is 2020, look at how much it skews toward the back half of the year, right? Stretching toward the back half. We can really see that here. 2021, a lot better. Although it looked like we were really strong here and then really weak here. That didn't have much to do with 2021 as much as it had to do with 2020. What was happening in the baseline period. So 2022, please guys, don't read into this. It's just that we don't have a ton of data. And so that's what the polynomial trend line looks like now. It is not real. It's just, we just don't have a ton of data. So that's the way it's trying to draw the trend line. I wish I had deleted it. I did not. So please don't get tied up in a knot over that. Okay, that was new listings. How about sales? What's happening with sales? So pending sales, pretty similar story. 2020, we see skewing over to the back half of the year, right? Where the peak of that market was August and September. When's the peak of most markets, right? Kind of May, June, right? May, June, July. 2020 was a different beast, a different animal, sort of reaching its peak late August, early September. 2021, pretty strong, hovering above 2018 and 19. And then here in 22, off to a pretty solid start. Remember, guys, I mean, I love this because it tells such a good story. We're off to a decent start, right? Look, we're above 19 and we're kind of, I guess, in line with 18. And looks like we're gonna cross above 2020 here soon. Technically, we already have. Here's the kicker. Here's the key. So far, signed contract activity looks fine, right? Looks okay. No issues, nothing to complain about. It looks like they're falling. It looks like it's negative news. Why? Because we're comparing against this, right? So last year was uniquely strong, especially right in the first half of the year. 2020 was strong in the back half. 2021 was uniquely strong in the front half of the year. And so it's not that this year is weak, right? Not at all. It's on track. It's actually, I guess, technically it's above 18, 19, and 20, but not 21. So in our weekly report and our monthly report, right, it's going to look like we're showing, minus, right? Sales are pending sales are down. And while that technically will be true, don't attribute that to weakness in this year's market as much as you should attribute that to strength in last year's market. Does that make sense? I hope that makes sense. I think it does. Y'all are smart people. So I know you'll get that. And it's just another tool in the toolbox that you guys can use when you're talking with buyers and sellers about what's happening and why excuse me, why what some of them might be reading in the news, while maybe technically true, it could be a little bit misleading. And I think it's worth looking at something like this, right? I think so. Call me crazy. I'm the crazy stats guy. I'm okay with that. Change in new listings by price point. This, my friends, is 2-year change, right? So we're comparing last month, Jan of 22 versus Jan of 20. Here we have some pretty dramatic declines in seller activity, right? Down 56% for 150 up to about 200. Biggest gainer, $500,000 up to 3/4. Second biggest gainer was $1 million plus. Overall, that's a 17% decline in new listing activity over 2 years. How about pendings? How about buyer activity? Very similar story. We see losses in our most affordable ranges. We see those losses moderating as we get into, call this mid-market, right? 350 to 5, 4 to 5. And then we turn positive as we get into $500,000 up to 3/4 and $750,000 up to $1 million. Million plus down a hair, right? Down, I think plus or minus 1 or 2, or, I guess 3%. It's just not a huge amount of change. So, I called this pretty flat and I call this pretty flat, but, these are definitely up and these are definitely down. Okay, so annually, right? I know here we are in mid-February. I know it's maybe out of vogue. It's kind of not as fashionable to talk about 2021 annual numbers, but here we are doing it anyway, right? Okay. So the data is much more illustrative. It's much more educational. It's more enlightening. And, it's less volatile, right? We kind of see, I don't know, what do we make of this? When we look at the annual numbers, right, you really see these declines. I mean, data is beautiful. I think there's a book about that. Is it Edward Tufte? Data is beautiful. It's like a perfect sine curve. It's like a beautiful sine curve, right? Kind of down and then up. It's just beautiful. Okay, anyway. So we can see these declines in our most affordable ranges. We see these gains in seller activity in some of our higher price, some of our luxury market ranges. And overall, that was down about 1% year over year, last year compared to 20. Okay, how about on the demand side? How about on the closing side of the ledger? Pretty similar story, right? If sellers aren't listing them, meaning they're not active, right? How would you like me to write offers on them? So of course we can't hit the closing table because we can't sign contracts on them because they don't exist, because they're not active on the market. So changing close sales, again, declines in affordable, some stabilization, flattening as you get into $250,000 up to 350. Then we start to see our biggest demand gainers are luxury. For better or for worse, like it or not, believe it or not, right? It's our luxury ranges. So biggest gainer, the price point with the largest year over year gain in sales was $1 million plus. 2, 3, 4, 5, 10 years ago, I don't think I would have ever said that, right? I would have never expected to have said that my whole career, that out of every price point, demand rose the quickest in $1 million plus. It's never been the case, right? $1 million plus. Hold on to your seat here. $1 million plus is a seller's market. Let me say that again. $1 million plus is a seller's market where sellers have control over pricing and negotiations, right? It has fewer than 5 months of supply. $1 million plus used to have 30, 20, 15 months of supply. Then finally it got down to 11 or 10 months. And I think people thought that was amazing. That was relatively balanced for that segment. Now, I think I saw 4.6, 4.7 months for $1 million plus, which is below that 5-month threshold, putting it technically into a seller's market. So it's kind of a crazy thing, but it's a thing nonetheless. So for 2-year change, you guys, I like to blend this and just kind of plot these together. Look at change in seller activity in gray, change in listings, change in buyer activity in blue, change in pendings. This is 2-year change, right? From last month to January of 20. So this is a 22 to 20 comparison. And here, we actually do see gains in seller activity, right? Pretty much across the board. If you just look at Jan of this year, right, there are still a few segments where we see demand growth exceeding growth in seller activity. But we're not seeing blue way outpace gray the way we were. I think a rational person could interpret that and conclude perhaps some of these segments are rebalancing a little bit. I think particularly some of those ones up here, if you look at some of the lower, more affordable segments, consistently, we see more of a decline in seller activity than we do in buyer activity. The buyers are there. It's the listings that aren't there, right? The listings aren't really there. Now, maybe I want to backpedal a bit. Not every buyer out there is going to be looking for 120K plus, even buyers in an extreme budget, right? With a pretty tight budget. It's just a unique animal. They typically require work. Not everybody is just suited or up to that. Yeah. And they tend to be smaller. And so, you know, folks who are thinking about families, not everybody is, not everybody has to. But those who are, I think, are thinking about a little bit more space nowadays with the pressure of telework and telelearning. All right, the market. Let's shift gears into longer term trends. Okay, we're up 220. I'm a little slower than I thought today. When it comes to data analysis, you excel. Okay, enough with the jokes. Twin Cities housing market activity. So this one I know we did look at. Just a reminder, I thought I saw, let me look at my participants. I thought I saw a few new folks on the call. I know 16128 looks like a new person. I see Bill and Brad and Carrie Lynn and a lot of repeat buyers. So I'm really grateful you guys are here. But just for those who aren't as familiar, we want to take you all the way back to 1967, right? It was a good year, right? I wasn't around, but I'm sure it was a good year. I hear it was a good year. So 1967, all the way through last year, we're looking at new listings in blue, metro-wide, and then we're looking at closings in red, also metro-wide. Because I know many of you have seen it, I just want to kind of blow through it quickly. The thing to keep in mind is the balance, right? The ratio, the balance. Look at how tight supply and demand are, or listings and sales, or buyer and seller activity, right? However you want to think about it. It's about as tight as it's ever been, maybe minus a period here where we were getting into our dot-com bubble, heading into 01, and maybe a little bit here, you know, in the late 60s there. But, you know, heading into 91 recession, we saw a buildup in supply and the demand wasn't there to absorb it. How about the Great Recession and the housing bubble, 07, 08? We saw this growth in supply. It looks like buyers were coming along for the ride at the beginning, but then 5-1 arms, 7-1 arms, you know, balloons, things adjusted on them. They all lost their jobs. Lehman collapsed. Everybody was just having a blast, the time of their lives. And and we all kind of know how that ended. So when we see divergence here, right? Convergence, divergence. When we see divergence here, it tells us supply is getting a little bit away from us while demand is sort of staying on Earth. So we got to be careful. What do you not see here? I do not see any supply buildup, right? I see just the opposite. Given where demand is, supply simply isn't where it needs to be, neither active supply nor incoming new supply from sellers. So there's sort of residual active that's left over. And then there's new incoming actives. So pretty tight. I mentioned the word ratio. Let's look at a ratio, right? So this is simply the same data going back to 1967. Instead of plotting both, I'm plotting sales, I'm plotting new listings divided by sales. So just the ratio of sales to new listings. What this 81% tells me is for every 100 new listings, we had 81 closed sales. Here, for every 100 new listings, we only had 30 sales. And here, only 40 sales per 100. But here we are at 88, right? 88 sales per 100 listings. That's as tight as buyer and seller activity has been since at least 1967. I'm comfortable going back further. I suppose the trend, you know, maybe, I don't know. I'm pretty comfortable saying since at least 1960, maybe earlier, but I can't say that with certainty. So this is, what is that? Is that a 55-year high? That's over a half a century high. Half a century high. I think that's a pretty decent record, right? You know, I think that's a pretty decent record. Okay. December new listings. Let's take a look, guys. Okay, so for December, look, we had this spike in 2020. We saw new listings up about 24%. Then we came down 18 to kind of, again, come back down to earth, right? 2525 versus about 2550. That's 25 more than 19, or excuse me. 25 more than 19. But yes, we had to come down from 2020. I won't say this wasn't a real number. It was real. It happened, but it wasn't sustainable. And it wasn't really indicative of this shift of a meaningful shift in seller activity. I know a lot of you would have loved for this to continue. I know a lot of us would have loved for that to continue a little bit. It's just not where we're at. It's just not where we are. So we're still kind of fumbling on bottom here, right? 23, 24, 25, 25. That 3,100, again, sort of sticking out like a sore thumb, pie in the sky. But yeah, we are looking for higher readings here. I'll take things that are obvious for 800, Alex. Thank you. Daily double. Okay. January new listings. So for Jan, right, we didn't see that uptick we saw in December. Not as great news here, right? December looked a little bit better. We were kind of holding the line here, right? We were holding the line. Forget that. We were holding the line here. And I don't see that support underfoot, right? I don't see that support underfoot. I don't think this is in free fall, but I really would have liked this to stay around 4,000 instead of 36. I really would have liked to stay around 4,000, but we're not, and such is life. So pendings, pendings came down about 11%, 3,200, right? Down from 3,300 in 2020, but down from 3,600, right? That was sort of another one of these pies in the skies, if you will. You know, I think overall, I don't really believe our demand trend has been broken. You guys will notice, right? We had a minus sign here, we've had a minus sign here, we had a minus sign here, and we have a minus sign here. A minus sign here or there doesn't mean your pattern's broken, right? It means there's a different micro trend on the path of your macro trend. Here I am fumbling with my hands here. You guys understand what I mean. So, you know, the stock market is up, right, over the last couple of years. Over the last couple of weeks, it's sort of been fumbling and sideways, but overall, overall we've still seen growth, and overall since 2008, we've still seen growth. We've had some faster growth and we've had some contractions, but I still think the trend is intact. So just keep that in mind as you guys are looking at some of this stuff. So that's pendings. Let's look at closings. So this is encouraging. 2,900. We kind of held that line and even kind of added about 100, a little over 100 to 3,000. But yes, that 16% was not sustainable given our inventory squeeze, given that crunch. Yeah, I think here too, we're still in an uptrend. There's been some down points on our uptrend, but I believe we're still on an uptrend. Now, if we have a couple, months or a couple years of confirmation, we can talk about a change, right? We can talk about a shift. I don't think we're there yet. I really don't. CDOM, cumulative days on market until sale. You're on the market for 10 days, then you're off for a coat of paint or whatever. And then you're back on for 10 days. You were really on for 20, right? That's the cumulative time you were on market in order to get an offer that you were comfortable with, in order for you to accept an offer, for your sellers to accept an offer. 21 days on market, right? That's fast, down 4.5% from the 22 days on market last January, right? You guys can see we were sort of, it looks like we were bottoming out around 43, 44, right? Really flattening out there. And then boom, minus 50%, no problem. And we've held that, why not? 127 days down to 21 days. Wow. All right, median sales price. I always say, let's try to make is it cents of the dollar? We try to make cents of the dollars or dollars of the cents, whichever it is. Median sales price, so up about 10.5% to 333. That's kind of a happy number. I wish we were clean at 333, 333. That would be a fun median sales price. Exactly a third of a million. 333, 333. Too bad we missed that. You know what we're not going to miss coming up, guys? 2/22/22, Feb 22nd. I'll be celebrating 2/22/22. It seems like something worth celebrating. Anyway, I digress. So 10.5% to just about 333. That was after 11.5% last year, up from a bottom of 140 and well above our previous peak for that last cycle at 226. Let's take a look at this. I don't always love showing tables of numbers. I don't. Most of you know that. But here I am showing a table of numbers. Okay, let's move my thing over. So take a look at this, guys. May of last year, right? That was our peak for price growth. That was 16.5%, right? So 11, 11 and a half, 11, 10, 16 and a half. But look what's happened since May. And by the way, this goes all the way through last month. So this is very current data. So 16 and a half down to 15, down to 12, down to 11, 10, 8. Okay, back up to 10, 8. Oh, back up to 10. So I guess, prices are still rising, roughly between 8 and 10.5%, right? While that's good news, I think for most sellers, it's still a little bit of unsustainable price growth in terms of the median income for our region and in terms of, wage growth for our region. So, yeah, sure, it's tempting to tell sellers, prices are still rising 8 to 10%. I'm sure they love to read it in the Strib and hear it on KARE 11 or Fox 9 or NPR, whatever it is they do, and whatever it is they read and consume. But the reality is, that's still a little rich, I think, in terms of a sustainable market. If the goal is to offer homeownership opportunities for all, then it's hard to be cheering for 10, 12, and 16% year-over-year price growth. Although I'm sure sellers, I'm sure many sellers were enjoying it, and homeowners surely enjoying it. A couple of people say that that's one of the reasons why inventory is so low, right? When prices are rising as significantly as they are now, sellers are enjoying the ride up, right? I'm going to sit on this. Why would it, yeah, I'm going to sit on this. This thing's making me money, and it's a place to live in the meantime. So I think there is this psychology. Sellers are really enjoying the ride up. I think moving forward, I think a lot of sellers are going to feel wed or anchored to their interest rate, right? They're going to be so in love with their 2.7, 3.2, 3.5. I'm afraid they're going to be happy with 3.9, given where things are at today, which is a little bit of a super interesting thought. We'll talk more about that. All right, percent of original, January. We actually went up 0.1%, 99.6, up from 99.5. You guys can see it was really last Jan that was the big bump. Clearly, 97 to 99.5. Well above bubble levels, right? We did hit 88 in the deep, dark depths and valleys of the Great Recession. And you guys can kind of see what's happened since. Let me just call out June. I always love to tease out June because we haven't had June of 22. Of course, I'm talking about June of 21, 104.25. That's metro wide. Now, I know Richfield, I think St. Louis Park, a couple other markets, I think Bloomington, but not as much. A couple hit 106, 107, right? I'm sure there was a 108 or 110, maybe in some of the further out areas with only a couple sales. But kind of an amazing number when you really look at how this indicator, how this metric moves, and relatively micro moves, except when the market is really moving a lot like it was here, or recovering pretty quickly like it was here. I mean, you don't see that. You just don't see plus 4.5% to surge over 100, even over 104%. We had been above 100 before, right? We had been above 100, but it was pretty rare. Okay, let me pause 1 second, you guys. 1 second here. Okay, and we're back. And we're back, folks. Okay, so that was June. I like to just kind of I like to rewind the clock a little bit to take a look at what that was like at that time. So, and another way to think about that is, 99.6, a buyer might look at that and say, 99.6, why can't I spend 91%, 89%, right? 88%. Well, 6 or 8 months ago, it was 104%. So, under 100% is kind of a deal nowadays, if you wish to frame it that way. Just spitballing here, guys. All right, January inventory. Okay, things are getting interesting here. I've got something new to share with you that Jackson and I have actually been working on that I think you guys are going to like. Okay, January inventory. Jan of 08, we had 30,000 active listings. 30,000 homes were listed under active status. Condos, townhomes, single family, new, existing. Uptown, as well as Hugo and Loretto, right? Chaska and everywhere else. So we're down 23% from last year to 4,300. We have 4,300 properties that are technically listed under active status in North Star, and that's a snapshot on Jan 31 at the end of January. So that's a month-end snapshot. Now, I know I've been saying this for a couple months with you guys here, but I want to repeat it. It bears repeating. Our inventory methodology, our process, how we count, how we do the math, has been consistent forever, right? So it's consistent back to 03. It's always consistent. It hasn't changed. It's a snapshot of the properties, of the listings that are under active status in North Star at month end, right? So what that leaves out is listings that came on Jan 10th and went under contract on Jan 20th. Those won't be active on Jan 31, but it did come on the market, right, in January, and it was, right, it went under contract in January as well. So, you know, now think about a listing that came on Jan 15th and went off on Jan 16th or 17th, right? And we know that's happening. Do you want to count that as inventory? It was active for 2 out of 31 days or 1 out of 31 days. You could make that argument, right? It was an active listing. It was something a buyer could write an offer on. I think something on which a buyer could write an offer, you know, but it was only active for 1 out of 31 days. But then again, our snapshot on the 31st of the month, that'll capture things that were listed on Jan 30th. If it's active on the 31st, it shows up in inventory. In our market where CDOM, where market times have never been so fast, never has that been happening more, where something that comes on, you know, in the middle of the month also goes off in the middle of the month. And therefore it won't be counted as it won't be counted under inventory. It will not be treated as active at month end because it's not in that snapshot. Well, excuse me, it seems like, you know, that's undercounting, right? It seems like that's undercounting because our median days on market is, well, I think we're 11 or 14. I think it was 11 November. Maybe we're 14 or 15, right? Half of the listings go under contract in under 15 days, 50%, right? Maybe it's 18. Now I have to look. Maybe it's more like 18%. So just know, you know, I think we're leaving something out, and it's just kind of the way it is based on the methodology now. But let me take a look at this really quick, you guys. What are we looking at? Days on market, and that's median, and that's everything. Okay, 21. But when we look at the line chart and we go back a little ways, what am I doing here? Oh, 3 years to my max. Okay, there you have it, folks. There's your 11, right? I wasn't lying. So 11 days on the 12 month. On the monthly, you know, so we're at 21 for January, but not that long ago, we were at 7 months, right? It was only last July. So, you know, 7, 8 months ago, 6, 7 months ago, half of the listings went under contract in fewer than 7 days. The other half took over a week to have an accepted offer, to be under contract. So, right, when that was 7 days, never did more come on after the first of the month that go off before the end of the month, right? So here are the bookends. There's a lot of product coming in here and going off here that aren't at the bookends. So it's an imperfect science, my friends. And as the game changes and the market and the pace of the market changes, we have to revisit some of this stuff. So one of the things that Jackson and I have done is we're sort of working on developing a new inventory methodology. And this is not official, this is not formal, this is not perfect, far from it. But let me just talk about it real briefly. Oh God, 238, very briefly. So what this does, so look at our old inventory calculation in gray versus our new real inventory calculation in blue. You'll notice our real inventory calculation is higher, right? That was kind of the goal, to get a truer picture and not undercount. And what we've done is we take all actives at the end of the prior month, right? So for January, it would ordinarily be December 31st, right? Or, well, excuse me, in February, we're reporting on January numbers. In February, for inventory, we usually use that Jan 31st inventory number. This way, we're actually using that December 31st inventory number with the assumption that the vast majority of those would carry over into early January, right? Not all. And then we add in the new listings that took place in January. So it's actives from the end of December, plus everything that was listed in January, minus what went under contract in January, right? And that's where we get these blue bars. Shout out to Pat Paulson. I don't think he's with us today, but he brought up, what about canceleds and expireds? And great point. You know, while it's not by any means a majority or maybe even a significant share of the market, we know it happens, right? So we'll have to subtract off those canceleds and expireds from new listings, right? So, you know, if we subtract those off, I guess I worry a little bit about erasing some of that difference, but I mean, the truth is the only thing that matters, right? This is a disappointing chart, you know, in terms of supply, but it's a real chart. And so, you know, the truth matters more than our feelings, right? Do I regret saying that? I don't think so. So, you know, as we take those off, we'll have to watch this. We'll be playing with this, but, you know, I want you guys to know we are rethinking inventory, the way that we approach it, the way that we do it, the way that our vendor showing time calculates it, which is a methodology that we built right here in MAR about 10, 11 years ago. And so it's not perfect. It's what we got, but it's not perfect. So watch for something like this moving forward. And if we don't officially change the metric in our reports, we'd like to do a blog or something, you know, maybe we put it in the weekly stats deck, something like that. So just watch for that. Okay, I spent too long nerding out on inventory. So now I got to speed through a couple of these guys. Month supply, only 0.8 months. Remember, 0.76 rounds up to 0.8. This is basically 3 weeks of supply, 3/4 of a month, 3 weeks of supply down from 9 months of supply. We are in an incredibly strong seller's market still. I think most of you have seen these by now. I'm not going to dive in. Just know seller's markets, there's only one unit of inventory, but everybody wants to buy it. Buyer's markets, here you've got 3 sellers, but they're only competing over 2 buyers. So someone's going to be left holding the bag after the music stops, right? There's not going to be a chair to sit in. We're looking for a balanced market that's balanced. You know, guys, I wanted to do some annual stuff with you. I knew we'd have a couple new folks. And I think our webinar last month was before we released annual numbers, I believe. So, you know, I just want to show you guys a few of these. We already talked about listings down 1%, you know, sales up about 3 to all-time highs. We did hit all-time highs for closings last year. Well, excuse me, we hit our all-time high since at least 03. I'm confident saying that is absolutely at least since 2000. And I'd say I'm 95% confident saying this is an all-time high record, right? There's no way that you could go back and see sales, right? There's just no way. However, I cannot say that with 100% certainty. I can only say that with 99% certainty that closed sales are at an all-time highs. With 100% certainty, I can say that never have buyers purchased more homes in a year for any year going back to 2003. I'm 100% on that. Days on market annual, there's our 11, down from our 100 and 116. Here, I already cheated. I already did this for you guys. I wanted to call out that 7. That is a remarkable, miraculous, unbelievable figure, right? We already talked about that, half, right? Median sales price annual, right? So we were up about 11.5% to just about 340K on an annual basis, right? Not on a monthly, on an annual basis. 11.4, that's the strongest number I've seen since 2013, right? That's a significant record. That's a significant high watermark. We saw 104.1. We also saw some 99, you know, high 99s. So overall, it was 101.9, just about 102%. So on average, sellers got 100% of their list price plus 2% for safekeeping, right? Because multiple offers, because under supply, right? Just because. So just how crazy is this market, and is it changing? Well, how about looking at the percent of sales selling at or above 100% of original list price, not current, but original. It looks like we were hitting a ceiling, right? We were experiencing some resistance overhead as we crossed 60%. And then enter COVID and just knowing what happened in the market last year. No problem, surging up to 80% of markets, 80% of sales sold for over 100%. Some of you are wondering, how can we have this 102 and this only at 80%? Of the ones that went above, how much above did they go? They might have gone only 100.1, right? They didn't all go 101, 102, 105, or 110. We do know that some went 10, 20% over, right? So let's do a little bit of price reduction analysis. And this is going to help us answer the question, are we starting to register a little bit of a shift? I'm not foreshadowing. Okay, so price reduction. So 50% of our deals required a price reduction kind of during the Great Recession period there when the market really kind of peaked and came down. 03, 28%, 2020, 25%, last year, 20%, 1 in 5. 1 in 5 listings required a price reduction before selling. Only 1 in 5. Here, more than 1 in 2, right? More than 5 out of 10. Okay, so let's fast forward this to October, shall we? Similar story, right? Pretty low in 03, kind of heading high into, this 08 to 12 period, and then coming down, right? So that trend is intact. October of last year, what do we see? I registered a little bit of an increase, right? 21.5 to 23.5. Now, 23.5 is the second lowest number anywhere on this chart back to 03. I hope you might notice that. However, it is not the lowest, and it is a slight uptick from October of 2020. All right, let's do the math. Let's follow this through. That's October. How about November, right? So look at the data, guys. October, November, October, November. The trend is the same, but the levels are different. Yeah, no wonder. In December, you're going to have 56% require a price reduction. Compared to October, we're only 52%. There's seasonality here, lots of seasonality. However, every one of these bars is October. October of 07, October of 12, October of 20, right? So it's all kind of that same fallish month. So annually, no increase. October, an increase. November, an increase. December, an increase. January, a slight increase. So that is 1, 2, 3, 4. Although, guys, this fourth one is pretty minuscule, 27.8 to 28.2. Technically, it's in the bucket, right? So that's 4 months of a pattern of a higher share of price reductions this, or I should say lately, than in the year prior, because it's not all this year. We're using October and November of last year. So we are seeing a very slight uptick in the prevalence of price reductions in the last several months compared to their year ago periods, right? I think that's the best way we'd want to say that. Most of you know my rule by now. 1 is random, 2 is a coincidence, but 3 might be the beginning of a pattern. And 4, I think, is starting to give us confirmation that maybe there's a pattern here, and maybe this is an early indication of a shift. Let me back up. When I say an early indication of a shift, I did not say a promise of a crash, okay? I want to be really clear about that. We're starting to see early indications of a rebalancing, of a little bit of a shift. I don't think we'll be in a balanced market for a long time, right? For a while. I don't think we'll be above 5 months of supply for some time. Until we get to 5 months of supply, the data kind of tells us, and history tells us, we're very likely to remain in a strong market where homes are selling quickly with rising prices and sellers are getting a pretty good share of their list price. Now, as we see this trend, kind of come to life, again, an early indication that perhaps things could be jiggling around, shuffling around, rebalancing a little bit. Maybe instead of 0.8 months of supply, we could be thinking about 1.2 or 1.3 or, oh my God, 1.5 months of supply. Wouldn't that just be just the greatest day? So, you know, when we see some of these increases, maybe we're talking about going from 0.8 to 1 or 1.2. We're not talking about going from 0.8 to 8 months of supply, right? It's just not what it's telling us. So this is the monthly. So that was the year over year. This is the actual raw monthly for every month of the year, not just year over year. And, you know, well, a couple things to point out. We're highlighting each Jan. So Jan of 19, 20, 21, and just last month, Jan of 2022. There's a lot to do these days, you guys. And every February, we have to extend every single one of our charts out, you know, one more year. What you got to get 2022. So you guys can see U-shape and a U-shape, but look at 2020, W shape. Price reductions came down heading into fall. An amazing thing that just is not expected and is pretty rare and pretty incredible. Cash deals, I think I've shown this for a month or two, so I won't spend time on it, but I know a few new faces here. How is it 10 to 3 already? Oh my God. So 4 to 5% cash, that used to be pretty typical. And then everything went on sale and we saw investors kind of swoon in and swoop up a lot of this. A lot of it was distressed product, right? Short sale in REO for 50, 60, 70 cents on the dollar, run it out, you got yourself a little cash cow that's appreciating. It's paying you dividends and it's appreciating. God, what a great industry. So 12.5%, so higher than the 5, but below the 23. You know, cash is staying a little bit elevated in the market, but, you know, clearly down. I wonder if people are chasing returns in real estate because they're not making any money off of savings. I think that's changing though. All right, inflation adjusted prices, you guys, inflation adjusted prices. In red, plain and simple, we've just got nominal home prices. These are the home prices that we paid at the time. Now, back in 03, that was the same as implied or inflation adjusted prices, right? Because there was no inflationary period because it was the same. As time has gone on, inflation compounds every year. And so look at this difference, right? It's substantial, right? Since 03. So this is 20 years of inflation. Now remember, inflation was running well below average for about a decade, right? From 2010 to 2020, inflation was running well below average at about 1.5, 2%. Now it's as high as it's been in 4 decades, right? 6, 7%. If you average out, right, we've had a lot of 1 to 2%. We've had a couple 6, 7. I guess it averages out to about 3 or 4, which actually is consistent with the historical trend. I think it's about 3% overall. Just something to think about there. Another thing to consider, look at red. Nominal home prices or just reported home prices, way above bubble levels, right? Way above bubble levels. But look at real home prices or inflation adjusted home prices in blue. Okay, so technically, yeah, they're a little bit above bubble, but not that much, just not that much, which kind of tells me, right, there's some room to run. There's runway ahead of us. There's not a cliff ahead of us, right? This kind of suggests that there is some runway. Guys, we read about this in the Star Tribune and in KARE 11 and on Fox 9 and on public radio. We hear and read about this. You don't hear or read much about this, but this is the truth. We don't have a choice. We can't pay with real dollars. We always have to pay with inflated dollars because we're paying now. Don't we wish we could pay with 2003 dollars, right? Not a chance. Heck, I wish I could pay with $1920, right? I'd love that. So just something to think about. All right, a note of levity. Let's take a quick little breather from all these stats. Don't leave though, please don't leave. Do you guys remember free air? Air used to be free. And now if you even see these machines anywhere, they're coin operated and air is like 50 cents or $1. And do you know why? Inflation. Inflation. The tires with the inflation. Anyway, sorry about that, folks. Let's talk about inflation. $190,000 in 03 would be $290,000 today. Now, why did I use that number? That's important. Look, we start at 190 because that was the median price in 03. So that's why we start there. So at 190, if we just due to inflation would get us from 190 to 290. But we're at about 340 right now. So 340 minus the 290 where we'd be anyway if there was no appreciation, only inflated dollars, right? So that's 50K in real inflation adjusted appreciation, which is about 2.5% per year. That's not that out of whack, right? When you think about it. So just a few things to think about. And yes, there is an inflation calculator. And yes, just in case you don't believe me, what cost us $190,000 in 2003 would cost us $290K in 2022, right? I'm not making it up, guys. I promise you. 190K in 03 would then in 2022 be 290 grand. You know, let's just have some fun. Or wait, 1920, 10 bucks in 1920, 140 today, 10 bucks, 100 years later, times about 14. That's about right. Yeah, 1300. Interesting. Inflation's a son of a gun. Okay. You know, pretty similar, you guys. I always like when our data and analysis is confirmed or mirrored in some, by some of the national data. I should say the process, right? The process, the methodology, and the insights, not the levels, but the insights and some of the trends. And so here we see real prices in blue, barely above bubble levels, and then we have nominal prices in red, well above bubble levels. Okay. Over 1 million plus. Let's talk really briefly. I know we're running short on time. I would be so delighted and tickled if you guys wouldn't mind sticking around just an extra 2 or 3 minutes with me, if you're able. If not, I completely understand. I do see there's a question or two in chat and Q&A, so let me get to those in just a second. August, closed sales over 1 million, 51% gain last year. Impressive. September, 5% gain. Still impressive, a little bit less impressive. October, oh. We see a 12% decrease, 12% decline. Just like we did with price reductions, let's do our same analysis. Let's see if this is a fluke or a pattern. November, sure enough, we're back to growth. December, sure enough, we're back to growth in our luxury segment. How about January? Sure enough, we're back to growth. So October was an anomaly. This was not the beginning of a trend. This was not the beginning of softening in the luxury market, right? I don't know if we can say we proved it, but we've looked at data that doesn't validate that was a softening, the beginning of a major trend change. Most of our data validates or supports the theory that there's still strength, the idea that there's still strength in the luxury market. We're still seeing demand growth, sales growth, and yeah, so million plus, still doing pretty well. 2021, just so you guys have an annual figure, up just shy of 50%, just about 50%. So 500 to almost 1,500, 3 times million plus in what, 16 years? Pretty substantial. Affordability, just a couple words, guys. Affordability was great when homes went on sale in 2011 and 2012. Affordability was great. Peak of the bubble, affordability not so great, right? Lower levels of affordability in 05, 06. I've done 2 forecasts. I was hoping this would be a little bit further out than it is, but it is knocking on our door. We are at 4% interest rates. That happened a lot more quickly than I thought. That happened a lot faster than I thought. So forecast number 1 at 360K and 3.75, which probably isn't that far off from where we are. Okay, that gets us back to 04 levels. But this is key. When we hit 380 and 4.25%, and I think 380 is 2 years off, but 4.25, as crazy as it sounds, I mean, it's possible, almost likely we'll see that. I hate to say in a couple months, but maybe in a couple months. I know the Fed and Chair Powell, all these guys are meeting in March, and actually I think they met recently, but they're meeting again. So long story longer, once we hit 380K and 4.25, that would put our affordability index at 130, which is pretty bottom of the barrel affordability, right, over the last 20 years. So interesting. You know, we're going to skip those for now. Urban market share still strong, little bit of a softening, but we see, we see that trend. So this is April, right? Enter COVID, kind of a decrease, and then we really saw a recovery. We saw a rally in urban market share, believe it or not. So when in doubt, zoom out. So let's just look at the 30-year fixed rate. Here we are, folks, 3.92. This is lagging, right? This is lagging. This is behind the market. What I like to look at, let's pull up our little inflation calculator and let's look at MND. What are they showing? About 4.1 on the 30-year. So they're showing just about 4.09, 4.1, while, let me hop back to, where are we? 30-year fixed rate from Fred. So these guys are still showing 3.92 versus basically 4.41. So, you know, that's a difference. I think that's a meaningful difference. So I really like to use this for the trend, but I like to use the MND, the Mortgage News Daily, for the level. So trend versus level. All right, so this is such a big takeaway, you guys. If there's one thing you take away, please let it be this. And those of you that stuck around, bonus points. So median sales price, right? Dark blue, 05, hitting its peak, kind of after the crash, into the recovery, median home prices above all-time highs, right? Above bubble highs. How about mortgage interest rates, right? Going back to 1990. So, 3 decades, mortgage rates are just about as low as they've been. In fact, they're as low as they've been in since at least, I think 71 is where the data goes back to, but I know it goes back further. So we can say at least a half a century low, right? So prices all-time highs, rates pretty much all-time lows. What does that do to our monthly PITI mortgage payments, right? Our all-in principal, interest, taxes, and insurance is basically back to break even. Now, this only goes to 2020, so 2021, right? Basically back to break even. Why? The answer is up here. The answer is right here. Rates have been the saving grace, the blessing from above, right? And low and declining rates have offset the effect of rising prices on payments, right? Let me say that again. Low and falling rates, well, until a month ago, they were falling. They're still low, but they're no longer falling. So I got to be careful with words here. Low rates have offset the impact of rising prices on monthly payments, on monthly homeowner costs, right? What a powerful chart to show a buyer who's feeling frustrated, who is just feeling sidelined, like they're going to be on the sideline, might help them think about getting back onto the dance floor. And, that's not doing you a favor, right? You guys tell your clients all the time, I hear you, waiting doesn't pay. And I think consumers say, oh, you just want to tell me that so you can sell me a home. No, next year prices will be 7% higher and rates will be at least 40 bips higher, right? 40 basis points. So yeah, I think that's real. So we're at 302, guys. There are 3 factors driving everything: COVID, the Fed, and supply and demand. I am really encouraged to see the daily trends in COVID cases. So this was the first, this was Delta, this is Omicron. It is really encouraging to see this coming back down to earth. Those who were impacted or who tragically lost their lives, I don't think would be encouraged by this trend. So I want to be really sensitive to that. However, for the economy, for the market, for everything and everyone, it's nice to see transmission declining a little bit. The US has a lower vaccination rate than any other country tracked besides Russia. 49% vaxxed in Russia versus 66% here. And unwilling, right, at 20% versus plans to get vaccinated, 18, right, versus US at only 6. So, other economies that are our size and, developed Western nations, I don't know, we've got an interesting culture here, don't we? Guys, forbearances, I just got a couple more here. Forbearances, folks are coming off of forbearance, not all, many are. This leads us to believe, and forget us, Ivy Zellman, one of the brilliant minds, and she was one of the ones who called the crash, or who called the peak of the market, right? The likelihood of us having a foreclosure and short sale crisis is roughly 0, right? It's roughly 0. So what are the implications of an insufficient supply of housing, right? So nationally, we lose over $1.5 trillion a year in lost wages and productivity. $1.5 trillion a year because of an insufficient and inadequate supply of housing, especially affordable housing. So this is a National Bureau of Economic Research working paper. This is peer reviewed. I mean, this is not made up. That's pretty incredible. So when people balk at, our state has a $7 billion surplus. Can we do a $300 million affordable housing bill? $300 million, that's a lot of money, no doubt about it. But sometimes little investments really do pay dividends long-term. Now, I'm not some tax and spend guy, I promise I'm not. But I am a fan of making important and targeted investments at the right time, knowing they'll pay dividends later, right? Spending $1 trillion on infrastructure sounds like a huge investment. Over 5-10 years, that will pay dividends and will save us in ways that we can't even really think about. All right, unemployment rate, large metros, kind of sticking with this. Minneapolis, here we are, I guess technically tied for fourth. Yeah, we're 2.2, kind of tied with these guys. I know, I don't like being tied to Milwaukee any more than you don't. Change in non-farm payrolls. Look at us, you guys. There's a reason they call us the North Star state, because we're just a bright, shining state, spreading sunshine on everybody else, right? And greatness on everybody else. So among the strongest, price growth. We used to have a joke a little while ago. Why do we watch unemployment? Why does unemployment matter? Well, unemployed people don't buy houses, at least not anymore. They don't, right? There was a time where if you could fog a mirror, you can get a mortgage, my friend. Not so much anymore. Average equity gain, we looked at these, $33,000 over the last year. That's the average equity gain. Some of you are scratching your heads, right? Going, no way, 33? Guys, that's 10% growth on a $330,000 home. That's 10% growth. There's 33 grand. So, I mean, 10% over the last year, I think we were what, 11 and a half? So even that's conservative. We're probably more like 40, right? 38 or 40. Yes, it still upsets me that Indiana beat us. Yes, it does. All right, as long as we're looking at maps, the most Googled should I question in your state? Should I delete Facebook, buy Bitcoin? Should I move? Should I have a baby? Should I text him? Ooh. Should I care? What is with these Maine people? Maybe Jackson can answer that.
Whoa, David.
Should I update? Wait.
We're over time already. Let's not get on Maine.
Look at Minnesota. My point is Minnesota, one of the most financially minded and frozen states. I mean, people care about their credit here. People care about their financial well-being, and clearly that trickles into how we approach homeownership and our nearly highest in the nation homeownership rate. So my only other, guys, mortgage rate projections, which just aren't really relevant anymore because we're already kind of higher than I thought we would be. And with that, I wish to wrap up. Let's take a peek at chat here. Josh, love that one. Looks like Bill did too. Okay.
And I will say, David, most of the questions in the Q&A were centered around whether or not these slides are available. I will let everyone know I will shortly be sending out an email to anyone who registered with a PDF version of these slides. So you will get both a copy of these slides as well as a YouTube link to this recording. So don't worry about that.
Thank you. Thank you. And thanks for coming, guys. We are so delighted and honored. Please do join us next time. The data is going to be updated. There's going to be some repeat charts, but some new ones. So please do come back. We're so honored you guys join us and just like to geek out with us on the market. So thank you. Thank you.
All right. And thank you, David. We will see you all next time. Bye-bye.
Adios.